Yes, the title of this video may come across as clickbait to many viewers, but as you will see throughout this recording, shocking new data is pointing to a troubling reality. Fresh reports are showing that there is a massive storm developing in the US housing market, one that will cause prices to sink to new lows, worse than what we saw in the Great Recession of 2008, possibly even rivaling the Great Depression of 1929. Just 1 year ago, we were experiencing the most euphoric housing market ever. Prices following March 2020 went off the rails. This followed a steady 11-year run where prices nearly tripled, but nothing compared to the 2 years that followed 2020. Home prices went into overdrive, showing signs of parabolic growth. But just as it seemed that things couldn't be any better, 2022 put an end to this golden age, and while the situation on the ground seems to be calm and orderly, there are now frightening new warning signs that the mainstream media seems to be ignoring. Signs that the market isn't just slowing, but rather crashing in a way we have never seen before. Read through the lines and you'll see what is clearly a ticking time bomb. To understand just how bad this is, we first need to understand a simple concept regarding housing. Just like you learned in your basic finance class, real estate is really like any other market, a function of supply and demand. We usually label supply as how many houses are for sale and demand as how many people can afford or want the house. And while these two factors seem relatively simple on paper, in the real world they are extremely complicated variables influenced by interest rates, new home builds, employment, migration, and dozens of other miscellaneous variables. In fact, before we go down the rabbit hole of this implosion thesis, we first need to understand that real estate has changed dramatically over the past 10 years. This is especially true in the single home sector. Certain factors are creating something that I call the rapid change theory, a revolutionary idea that many economists are now starting to accept as the mainstream. What we believed to be a steady asset before is now much more volatile, and in the last few months, we have seen this volatility exposed on the downside with prices in certain markets plummeting. Obviously, with real estate becoming less viable by the day, options for investors are shrinking fast, especially as Goldman Sachs released a shocking report saying that the classic stock bond strategy won't be enough to keep investors afloat. It's down 34% this year alone, its worst performance in a century. As a result, Goldman says the ideal allocation for stocks has shrunk from 60% to 45%. So what do they recommend you do with the difference in order to salvage your stolen returns? Invest in real assets like fine art. It's surprising to hear, but Goldman Sachs says fine art can protect your purchasing power even in the face of rising prices. The last time inflation was this high, it appreciated an incredible 17.5% per year on average, outpacing even REITs during that time. If you're looking to diversify your portfolio with fine art, Business Insider said one platform should be the go-to. It's called Masterworks. The platform qualifies paintings with the SEC, turning legendary art into an actual investment for a fraction of the full price. You can view all their offerings on their website or at the EDGAR database linked in the description. To date, Masterworks has had a total of 8 exits, with 5 of them this year alone. Masterworks' last 3 exits delivered 17, 21, and 33% net returns. One of those was as recent as 4 weeks ago for a 17.8% net return. Masterworks has nearly 600,000 members and paintings have sold out in minutes, but you can get priority access when you use the link in the description. Now, with all of that said, let's go back and examine this volatility I was talking about earlier. You see, real estate markets are much more susceptible to price drops than what was previously believed, as they are much more sensitive to demand changes than previously understood. For decades now, economists have looked at the house as a commodity. After all, it's shelter, and shelter is a very important need. This makes houses, according to these experts, very resilient to changes in supply and demand. But the concept of a house has changed. Today, a house in many parts of America has become a sort of private banking vehicle. Think of it as an ATM. You can extract cash from it by getting something like a HELOC loan to go against a rise in equity. Obviously, over the past 10 years, home values have soared, so this has made a lot of Americans very rich, thereby accidentally making the house a very important part of the American economy. It's invited massive speculation in the form of both private and public investment and made housing more of a financial industry rather than what's supposed to be a home industry. In fact, this is no secret to economists. The housing wealth effect is a well-understood phenomenon. According to various studies, a $10,000 increase in housing wealth leads to about $276 of additional consumption. Multiply this all over America, and you can see how home prices quite literally control the economy in a very substantial way. So with all of that said, what does this have anything to do with the housing crash that is supposedly going to be historic? Well, all of these facts have essentially created a leveraged situation in the housing markets. You see, prices went up double digits for the past 2 years, and this has increased spending and pushed the economy along via the wealth effects. But now, as the Federal Reserve tightens to prevent inflation from running out of control, the market is slowing down in ways we have never seen before, and just as fast as things went up, they are now collapsing in the same manner. This is because we have created a self-feeding loop that emphasizes both growth and decline. The faster home prices went up, the higher spending improved because of that wealth effect, and the better the economy ran. This self-feeding supergrowth caused this. If you had told a housing expert in 2020 that housing values would be up 30% in 2022, he would have laughed at you. This hypergrowth was made possible through this self-feeding loop induced by the fact that the house has become an ATM, and in the same way things went up, things will fall. When the loop slows and reverses, the same type of acceleration can be observed to the downside. While we are only in the initial stages of this decline, we can understand just how bad it is by looking at the pace or how fast prices are falling. Over the last 3 months alone, the change in the 3-month price delta has fallen to a record low. It's worse than what we saw in 2008. This suggests that buyers have thrown in the towel, and because of the way the system functions, a peak is really all we need, because after that the avalanche begins. Sure, by looking at the raw numbers the damage doesn't seem so bad, but it's the deceleration that's shocking a lot of people. Housing is one of the least volatile assets in the world. At least that's what the common belief was. Even when there is a crash, things tend to move very slowly. For example, in 2008, it took over 2 years for prices to bottom out. So if you were an observer in March of 2007, there really wasn't much of a signal that we were about to enter the worst crash since 1929 in terms of real estate. Opendoor, which is a company that specializes in essentially flipping houses using a data-driven AI approach, is down over 95% from its peak. This isn't just a downturn, this is a complete meltdown. And even if we look at more traditional companies like America's largest home builder, D.R. Horton, its stock is down 25%. It's across the board. Experts are now predicting the worst. Many who were quite bullish or neutral about the market just weeks ago are now changing their tune. One of those is CoreLogic, which is one of the biggest real estate data aggregators in the nation. Their models are often quoted in mainstream financial media, and just a few days ago, their model on which US counties are predicted to have lower values in 2023 did a complete 180. In March, the map looked like this, with the majority of the United States very unlikely to undergo value drops. Just 6 months later, the map now looks like this, with the vast majority of US counties now flashing red, indicating they are very likely to drop. This is starting to look like the beginning of a prolonged, multi-year housing recession. And that starts to beg the question of how far we can drop. Well, as far as the worst case scenario, we have to go back to 1929. Now, I understand that this was close to 100 years ago, but while the world looks very different today, it still stands as a well-recorded, well-understood point in history that we can look back to as the worst possible scenario. In fact, economists have done entire papers on the 1929 real estate crash. This one, labeled Real Estate Prices During the Roaring Twenties and the Great Depression, showcases what was happening by examining the New York market. What researchers conclude is that the market back then fell over 67% following the Great Crash of 1929. But it's not the crash that's significant, it's the recovery. What researchers found is that while the crash was painful, the Manhattan real estate market didn't recover until 1960. Yes, you heard that correctly. According to the New York City Property Tax Report of 2000, it wasn't until the 1960s that assessments in Manhattan exceeded their pre-depression level. That's over 40 years. This evidence at the very least shows that real estate cycles can take decades, and with our recent run-up, the similarities between those 20s and our 20s are eerily similar. Now, of course, the world is a very different place today, and I'm not saying that a 1920s crash is likely, but it goes to show that a downtrend can last much longer than anyone anticipates. What we do know is today's deceleration is historic, and how far we fall has yet to be established. Now, a worrying amount of data shows that this crash can very easily reach 2008 levels, and the recovery may take much longer than what most experts estimate. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it.